Hey, welcome to Investing with Stef YouTube channel. My name is Stefan, and in this channel we talk all about investing, and we give you the information to just even be a better investor or just to start investing. Today we're going to talk about dollar cost averaging, what it is, and the difference between dollar cost averaging and what you know as the margin of safety investing. What is the benefits between the two and the way I like to invest, and we're just going to touch on the basics. So let's jump right into it. What is dollar cost averaging? Dollar cost averaging is simply this is the formal definition, is an investment strategy in which an investor divides up the total amount to be invested over time. So what that simply states is you will buy a certain amount of stocks over a period of time. So let's say you have a certain amount of money, you buy in January, you buy 10 shares at $30, and then in February you will take that same amount of money, $30, and you will buy in February you will buy again, and then in March you'll buy again, in April you'll buy again, in May. So over time you will put in your money. And basically this is a great strategy to do if you don't want to do a study into a company, you don't want to you don't want to see what is the value of the company over time. You just want to put in your money and know that your money will grow as you put it in. Now, with this example, the guy took $150. He put in 30, or let's say he put in $30 a month, or the girl, he put in $30 a month. In January, he got 10 shares at $30. In February, he got 30 shares, and so on. So he did $30 a month, and with $150, and he got 87 shares over this 5-month period. Now, if he would do a lump sum, let's say he would take that same 150 and he would put it in all at once, he would have got 50 shares in January, because he would have put in 150, so divide by $30, he would have gotten 50 shares at that time. So you can see the difference between the shares. But let's say the guy or the girl waited and didn't put in January, you put it in February, and then he would have got what, 150, he would have got at $10 150 shares. So you can see there already that this scenario is a little bit flawed to the one side, if he just waited, he would have got a little bit more. And it's a great strategy for when the stock market is going sideways or even downwards, because if it goes sideways, you buy in at a high price, you buy in at a low price, and over time you will balance your portfolio pretty nicely. And then if the stock goes down, obviously you put in the same amount and you will get more shares as the stock goes down. But the caveat is, what if the stock market keeps going up and you keep dollar cost averaging? Then instead of putting one amount one time and waiting for your dollars to grow, now you put in the same amount every month, but you get less and less and less and less shares. So yes, if you don't have all the money to put in once, of course you want to do it over time. But so this strategy has got positives and negatives to it. There was a study done by Vanguard that they took $1 million and they said, okay, they're going to do 2 studies, one either lump sum and one dollar cost averaging. The dollar cost averaging was done over a 12-month period, and the lump sum was done obviously all at once. So they took United States, UK and Australia. United States they took over a long period of time, from 26 to 11, and UK only from 76, and Australia 84. They realized that a lump sum outperformed the dollar cost averaging by 66%. So yes, if you had the money and you put it in at a time and you waited, this was also done over 10 years. So if you waited then for that 10 years, after the 10 years you would have outperformed. But not everybody has got the money all at once to put into the stock. So this strategy is for people that gets a monthly salary and they want to put in their money monthly, and you can do that. Is not so bad. But there's a better strategy to this. It's called the margin of safety strategy. I've talked about this in my previous videos. You can go have a look at some of them, or go look at any of the videos on margin of safety and dollar cost averaging. Now, what is margin of safety? Margin of safety is an example that we have in a stock, that you buy it lower than the value so that you have some safety. If the stock goes down, then you don't lose too much money. So let me give you an example. You build a bridge at £30,000 for trucks to go across, for £30,000 trucks to go across, and then you drive £10,000 trucks across it. So you have that 20,000 margin of safety so that the trucks won't break the bridge. And that is the same thing when it comes to stock. You want to buy it at a very low price, but how do you know when to buy and what to do? So that's why we use strategies to work out the price that we want to buy at, and that's called the margin of safety price. So I'll give you an example. So you're going to work out the intrinsic value of a company. Let's say you worked out the intrinsic value of a company and it's $50. The margin of safety will be $25 from there because it's $50. And then the current stock price is at $40. Now you will not buy the stock if it's at $40 because it hasn't reached your margin of safety ideal price that you want to buy in. So what you're going to do, you're going to wait. Now, to get back to the intrinsic value of the company, how do you work out the intrinsic value of a company? How do you know what's the company worth? Now, there are hundreds of ways to value a company, and it's also relative to the investor and is subjective, right? So you can use free cash flow analysis, you can use the discounted cash flow analysis, you can use payback time, you can use the margin of safety calculator. I do have some videos on that. Just go back, I'll put a link here on some of that videos as well. I did a whole series of the 4 M's of investing. So after you calculated the margin or the intrinsic value, now the intrinsic value will change over time. Obviously, if the company has great management, if the company has good growth, a good product, if they have a great competitive advantage through their moat, their company will do better over time and the intrinsic value will go up, right, if the shares stay the same. So then of course the margin of safety will then go up with it. So you need to always be aware of the intrinsic value of the company. And then you have to obviously look what the stock market is doing right now and what is the stock price. And you basically also dollar cost average, but you just wait for the stock to get to the margin of safety and then you just buy. Now, how do you buy? Do you buy a little bit at a time or do you buy all at once? Now, there are different strategies. I'll tell you my strategy as well, but first let's go to Warren Buffett's strategy. So he says that opportunities come infrequently. So when it rains gold, put out the bucket, not the thimble, not a little thing like this. Put out a big bucket, meaning that when it rains gold, when the opportunity comes, when the company is at its margin of safety, that doesn't happen very often, then you want to go out and you want to put in as much money as you can and wait for it to grow. Now you probably ask me, Lan, but why would the stock price go to $25 if the company is worth 50? Why would it go that much? If it goes that much, that means that the company is there. There is a theory like that. It's called the efficient market theory, meaning that the stock price will always show what the company is worth. So if the stock goes to 10, that means that the company is either indebted or there's something wrong with the company and it must be at 10. So the market always prices in the right price. And that is not true. Because think about this is the auction driven market. Companies stock prices move up and down as there are fear in the market and there's greed in the market. So let's say there's an event around the world and that pushes the stock prices to go down out of favor and people have to sell for whatever reason. The stock price will easily go to the margin of safety, and that is when you want to jump at it because you have done your research through watching videos, through studying, through reading, through understanding the company, the management, the moat, meaning the safety of the company and how good it is, the growth, the products that it sells, the industry that it's in. There's a lot of reading and a lot of studying that it goes into investing. But anyways, so if you're watching this video, you're doing a fantastic job already. By the way, if you like this video so far, please go ahead down. If you've learned something about different about discounted cash flow analysis, what did I say? If you've learned something about the dollar cost averaging, if you haven't learned anything, still go ahead, subscribe and like the video down below. I would really appreciate that. We're trying to reach 10,000 subscribers. So Anyway, so let me give you an example what I like to do. I like to buy in tranches, meaning not all at once, because you know you never know what the future hold, and I don't maybe I'll have all the money to put in ones that I want to put in the stock. So let me give you an example. Let's say this one here is a this is the intrinsic value of the company, right? And this blue line here at the bottom is the margin of safety. So let's say I wanted to buy this company, so I keep looking at it September, October. In September, I realized, hey, it's at intrinsic value, so I obviously don't buy yet. So I'm waiting, I'm being patient, again at intrinsic value. Then in November, between November and December, it reaches margin of safety. Now, I could have put in all the money that I wanted, or I can say, you know what, let's buy in a tranche of 50%. I want to take $10,000, I want to put in 50% into this company of that $10,000, right? So I take 50%, I put it in. Then my 50% will grow. Obviously, I don't sell because I'm a long-term investor, so it keeps going up. Then it comes down again to margin of safety. Now I think, okay, should I buy again? Then I don't buy and I wait until, let's say, in January. So January comes around, between January and February, there I can buy again. So I still have that cash that I wanted to put into the company, and I can deploy it again, and I can put it in. That's why I didn't buy everything right there. So, and then the stock price go up again from there. So there are some positives and negatives in the way I do it, but I believe in buying not small amounts like every month 10%, but to buy in tranches, meaning you can buy in. A lot of people like to buy 50% because that is the time. You won't lose out too much if it goes up. You won't lose too much when it goes down. And when it goes down, you still have that other 50%, or maybe you can put 25% as it goes down. So as you can see, we still invest like dollar cost averaging, but we just do it with a calculated way, with a brain and not brainless. And that's why I put this picture here, because margin of safety investing means that you have to think about investing in a company, and you don't just do it blindly where you just put in money every month and you just keep going forward. A lot of people like to do it. I don't think it's the best strategy in the world, but I think it is a good strategy to put in your money over time, but to do it calculated, to understand the company and why it's going down. So again, thank you so much for watching this video. I hope that you learned something, and go down below, put a comment down below. What type of strategy do you like to invest in? How do you buy companies? Do you buy all at once? Do you buy a little bit? I would really like to hear from you, and it will also help the algorithm so that we can get this to as many people as possible, so they can learn about different ways of investing. Again, my name is Stefan, and I'll see you in the next video. Have a good day. Bye bye. Enjoy the other videos.